The war in Ukraine and numerous sanctions imposed by the US and European countries have turned the market into another hotspot today. In fact, Russia is becoming a global economic outcast. The sanctions do not yet affect energy supplies, but any sign of Russia's tightening military grip around Ukraine may quickly lead to supply outage. In addition, foreign partners are joining states in blocking Russian companies. As a result, oil and gas quotes have edged up since the early trade. Their growth of 7% is not as significant as in other segments. Nevertheless, this signals that the oil market is about to advance sharply, thus increasing the risk of a real supply shortage. Against this background, it can be assumed that oil prices will most likely head for new all-time highs. Now let's take a look at the chart from a technical point of view, although it makes little sense to rely on technical analysis tools under such trading conditions. Amid panic tumbled through financial markets, Brent crude oil futures are still moving around the level of $100 per barrel. The asset continues to gain upside momentum despite its high overbought status. As for short-term price changes, the quote may partially close the price gap recently formed in the market. Currency market jitters have been fueled by the news about Russia's exclusion from SWIFT. The enterprise has now targeted the country's largest financial institutions, holding nearly 80% of the Russian banking sector's total assets. Moreover, EU policymakers have agreed to withhold Russia's foreign currency reserves and gold assets, most of which are denominated in dollars and euros. In this situation, it's not surprising that the dollar has jumped to almost 110 rubles and is still in an uptrend. Thus, the Bank of Russia has limited options left to conduct any foreign exchange interventions. This forced the regulator to raise the key interest rate to 20%. This emergency rate rise was a bid to halt the rapid depreciation of the value of the ruble against the dollar. However, this step has brought no results yet. Analysts believe the Russian currency is likely to extend losses. The markets are in panic mode and investors are fleeing to dollars. At the same time, all world currencies are currently trading under pressure. Thus, the measure taken by the Bank of Russia may just slow down the process of ruble depreciation and lead to a new hike in the key rate. The dollar-ruble pair is coming under enormous pressure from fundamental factors. The market is being driven exclusively by geopolitics and speculators. Thus, 100 rubles per dollar is no longer a sky-high level, but a conquered peak. In this situation, there is no point in relying on technical analysis. Trading should be based solely on the news flow. Amid turmoil in global markets, the behavior of gold is rather weird. Instead of gaining, the yellow metal is trading sideways and sometimes slides, crossing the level of $1,900 per ounce. Apparently, the market participants are concerned about restrictions on the Russian central bank's international reserves, including gold futures. Nevertheless, gold still has every chance of resuming its bullish run, thus confirming its reputation as a safe haven asset. As soon as market participants mull over the news of the sanctions against the Bank of Russia, gold prices are expected to edge up again. In the meantime, confused investors continue to pull gold quotes up and down. This indicates uncertainty in the market. As for price levels, the area of $1,880 per ounce can be seen as a pivot point. Despite all this, the metal is still trading in an uptrend. This means that gold may well resume its growth and head towards fresh local highs. This was the forecast for the beginning of the week. Take care and trade prudently. Watch our new videos and stay up to date with the latest news. See you back soon.